Okay, so thanks a lot for inviting me to discuss this paper. I have done some work on thinking about macro finance models where you have exactly this thing arising very naturally, which is the total payout. So I thought it was a very interesting read and a thought-provoking set of facts that are put out here. So let me start with some of the motivation. As most of you have seen, we have a large literature in sort of macro finance exchange economy pricing, and I'm not going to go through unlike Adriano's literature review yesterday. I'm going to do a very brief thing here and just say that Mera, Prescott, Campbell, Cochran, and Bonds on Your Own are kind of the classic papers. Maybe also add some disaster risk. What they're doing though in those papers are trying to get the joint dynamics of consumption and dividends right relative to their preferences to match the moments, okay? And the dividends we're talking about are per share dividends, okay? And so what that means is actually dividends to a particular trading strategy. And that trading strategy is that you bought, say, $1 worth of the crisp in 1926, and then you take the cash dividends. If any company asks you to repurchase a share, you say, no, I do not want to take that. I want to keep my shares, but I will take the cash dividends. And so this trading strategy actually has a price, a market. There's not the market value of equity, right? Because you're not accounting for all these repurchases. So it's sort of it feels very different. It's going to be a different dividend process from the one that's actually paid out every year by the corporate sector. But there's nothing wrong in it, okay? Because period by period, the return has to be the same. So it's a totally legitimate thing to do, and that's kind of what this literature has been doing. Now, if you're going to think about a macro finance model with production, it's not so straightforward to talk about. There's no natural way to talk about those dividends. Okay, the dividends that come out are the payouts from the firm, and so for these models, this is a very natural set of data to consider. There's relatively sparse existing literature, so I just want to say sort of what did we know for sure, kind of coming into this. And it's not that there's a sparse literature on issuance or repurchase necessarily, but on these aggregate implications and pricing implications. So Buduk, Michaeli, Richardson, and Roberts basically did this for equity and looked at repurchases and issuance. And one thing we learned there, I think, is that repurchase and issuance activity is quite volatile. So I feel like we just did sort of know this for equity. And Lorraine and Yoga does this for the total corporate sector, but they don't have market values, okay, of debt in particular, and do it a little bit differently too. So I think we knew sort of something that, and they also find this high volatility. So we kind of knew that repurchase and issuance is important, it's quite volatile. But this added evidence, I think, goes a step further, okay, particularly on the debt side. So the first part of the paper is just data. It's very interesting. It's a pretty careful data job as far as I could tell. Bond market prices, that kind of is a distinguishing feature. That's important. Crisp CompuStat for equity, et cetera, et cetera. And they're trying to account for double counting. Some corporations like insurance company will hold a lot of debt. You don't want to double count that stuff. So I feel like they're trying their best. They're doing a pretty good job. The empirical takeaway, the first one is that total asset risk premium and volatility is close to equity. I think we kind of knew that in the sense that we already know corporate bonds have a positive risk premium. We know they're relatively volatile. We know they're positively correlated with equity. So the total asset is probably in the same area, a little bit lower risk premium and volatility, but otherwise pretty close. What we found is that net issuance, or they found, including debt, is much more volatile than cash distributions. And importantly, I didn't know this, but maybe some more handsome and smarter people here knew this, but debt issuance apparently is incredibly volatile too. So that is an added thing. So this is very volatile, an order of magnitude more so, okay? So if you look at total payouts, this is totally going to dominate. Cash distributions are pro-cyclical, debt and equity now at short and long horizons. So this is begging for a long and risk model. The net issuance, however, is acyclical, okay, at short and long horizon, and that's the kind of feature that seems a little puzzling, or is it, right? So I started thinking about this, and in the abstract, they set up the puzzle, right? So corporate payouts are acyclical. The risk premium, the Sharpe ratio is the same as for equity. That challenges the notion of risk and return, because I know you want cash flows to drop in bad times, okay? That is risk, and they don't seem to here. So what I was thinking is that, I don't know much, but I do know that, if you have a production one firm, Cobb Douglas, with a capital share of a third, you get this type of total accounting at the aggregate level. You get that consumption is output minus investment, okay? That's always pro-cyclical in any reasonably calibrated model. Investment is way more volatile than consumption, but the level of investment is much smaller than the level of consumption, so it goes that way, okay? But if you look in these models, and this is a bunch of models like this, okay? Total payouts is, I'll call them D here, dividends, but there's, it's including everything here. It's the alpha YT, so that's the capital share, a third maybe, times output, minus investment, okay? What the firm gets minus what they invest. Now, this thing can easily go negative, even if the technology shock is positive. And it's not that unintuitive, right? Because if there's a positive technology shock, what do you want to do? You want to take advantage of the technology shock. How do you take advantage of it? You get more capital, okay? And then you'll harvest the returns later. But if you need more capital, that's issuance, okay? So you need to put money into the corporate sector, and now you can pull payout down in response to a positive shock. Now, equity valuations, of course, go up, because this is good news. High technology is good news. And so that's kind of, there's a sense that there's a simple kind of channel that can certainly make payouts even counter-cyclical, but you still get as risky an asset, okay? And in particular, you might take this type of production function and you might marry them with Epstein's in agents and you create a model out of it, and then, which I did. And then, in our model, the total payout tends to respond negatively on average to large positive tech shocks, okay? Another example would just be if there's a persistent growth rate shock, like Max Croce has in his paper, okay? What happens then? Let's say it's a big technology shock, it's a revolutionary shock. It might not kick in immediately, but you want to invest very quickly. So payouts drops down, okay? So it's easy to kind of get this thing. It's somewhat sensitive to calibration. So my sense is that, you might be able to generate something kind of acyclical. Depends a little bit on this, the magnitudes here. I think a pretty robust implication of this set of models is that in the long run, you should see some benefits, right? You might drop it down right now, but in the long run, you should get this benefit. So the only question then is, with this very volatile stuff, is how much power do you have to detect that? And that, I think, is an interesting question, which I don't know the answer to. All right, do we ever see this? Well, let's look at a very big technology shock. We have one, the dot-com boom, okay? So I took this is from their paper, and I stretched out this one period, okay? This is sort of the 90s, equity payouts and debt payouts. So she didn't show you, but it's in the paper. And this is the cash payout. These lines that are the dashed uninteresting lines. This is net issuance, and this is the total payout. Okay, so this is cash payout. This is total payout. Now, the fact that total payout is below cash payouts means that there's positive issuance. So what happens in this period? Well, it seems like the firms are issuing, and in particular at the very end, they're really issuing equity when the equity prices sort of jumped up here. What happens to debt? Well, debt looks the same. They go the same way here. You see that? So debt also tends to issue. I'll call this the LTCM crisis or something like that. I'm not quite sure. But generally speaking, the debt is also issues. They move the same way. So in this sense, in this sample here, it seems like total payout, if you add them together in the right way, will tend to sort of be negative in response to the big technology shock, okay? So that's sort of one thing that's happening in data. So I'll get back to this plot, because I'll show you this is a specific time, and things look different at a different time. Before that, I just want to say a couple of things about the model. It's a standard bounce on your own model. So it's an exchange economy, meaning that the pricing kernel is effectively exogenous, right, relative to the problem here. We're just going to put down some dividend dynamics. We're going to price them, and that's what they're doing. So I'm going to focus on that. The cash payouts are modeled as log dividend to consumption. They're kind of mean reverting, so the dividends and consumption are co-integrated, 1 minus 1. This makes a lot more sense if you have total payouts than if you have this trading strategy that we talked about earlier. Okay, so now that makes a little bit more sense. This is where the risk premium comes from. Okay, this phi s is calibrated to 6. In these models, it's often 3. And so it's a really big thing. And so this type of cash dividends are incredibly risky because they're really low on this long-run component, okay? So, and that sort of makes some sense. The net issuance is modeled, they add this consumption just to keep it positive, it's fine. But then it's just this shock here This thing appears in the pricing kernel. This is the consumption shock. It can be correlated with it. Not a big deal. This one does not appear anywhere. This is just total idiosyncratic shock. So issuance activity in this model is a little bit of a sideshow. Okay, thanks. Right? It's just these shocks that are hitting. These guys are just issuing, not issuing, etc. But it does fit the data at some level. Okay? But it sounds intuitively, to me, economically, a little bit. I feel like I would like to see more. Okay? And so I'll talk a little bit about that. The model matches the standard moments because of this. Here we get the risk premium, and here we get the acyclicality. This thing is way, way more volatile than these guys. So all the payout dynamics are dominated by this little bit of a sideshow here. Okay? So that's kind of mechanically how the model works. What's the purpose of the model? So I feel like, it wasn't spelled that clearly out. The puzzle, it might be a puzzle here, but I feel like they could refine it a little bit. One thing I would say is that if you have two ways of looking at the data, that if you do your measurement correctly, should give you exactly the same answer, then it doesn't matter if you have the right pricing kernel, right? They should both give you the same answer. But if your pricing kernel is wrong, it might be that the dynamics of the other ones could be, be correlated with something that's actually not priced. And so the other dynamics, you could maybe, so you can think of this as a test of a long and risk model. I think that's one way in which it's saying, hey, the long and risk model can handle this alternative perspective. Now, of course, there's also debt. So that's a nice thing. I won't talk too much given time about this, but alternative purpose could be that the measurement is easier and the co-integration restrictions, but given time, I'll just move along. Oh, by the way, I would like to see you estimate and not calibrate if you can. I just much more convincing if you can estimate directly on the cash flow data and not just calibrate. So I would like a lot more facts. I think there's a lot to learn from this data, and I feel like they just kind of scratched the scratched the surface. In particular, I want to know if these guys, if there's net payouts or if they issue a lot, does it go to investment or do the firms just hold it, right? Where does this money go? Or is it paid out because that would have implications for the model. This is just paid out to, say, workers or someone else. Okay, so where does the money go? Does it depend on the state of the business cycle, et cetera? And if so, what does it depend on? So let me just show you this graph, okay? So what I showed you earlier was equity payout, debt payout. I showed you this time period. This is the dot-com boom. What do you see? See the red line is they're positively correlated, basically, the lines between debt and equity. Every other period's strong negative correlation. Seems like, when they're issuing a lot of equity, they're sort of taking down debt, right? Or they're issuing a lot of debt, they're repurchasing equity. So there's always this thing going on. So it feels a little bit, there are people doing this. There's probably a purpose, okay? It would be nice to understand a little bit these endogenous decisions, what drives them, as opposed to just have this kind of epsilon thing. So that's kind of what I would, encourage the authors to dig a little bit deeper into and figure out what is explaining it, okay? I won't talk much about this, but you might think that some of it might be some sort of sense of there's some sort of market timing if you go outside a rational paradigm, maybe. There might be something to do with you feel like equity is expensive relative to debt, so these things are happening. Now, a lot of this managerial timing might be just a transfer, but it could be across people in the economy. It could be correlated with aggregate movements. And so I'll give you a precise thing. You could look at correlation of issuance and payout. Think about correlations with the price-dividend ratio, risk-free rate, or credit spreads. They're sort of, the two first one are directly observable in your model. This one you have to work a little bit harder. But they seem like these might be informative, right? In particular, in the dot-com boom, it seems like there was a very strong correlation with the price-dividend ratio and equity issuance and debt issuance. And so I feel like there's a lot of things to talk about, and that the paper just sort of got scratched the surface, okay? That's my overall thinking about that. So I greatly enjoyed reading it. Certainly there are many things going on here. The stylized facts are useful. I want more. I want to understand this more. It does help with specification search for these macrofinance models, I think. I'm not super enthused, I guess, about the exchange economy, but you're able to do it, and that's good. But I think you just can teach us a lot more about what's going on in the data. So other than that, I thought it was a really nice paper.